And now we're going to start a new chapter, Chapter 9. And Chapter 9 looks at two things. It looks at fiscal policy and looks at the federal budget. Start with fiscal policy. We've talked about fiscal policy before. We talked about not discretionary fiscal policy. We talked about restrictive fiscal policy and expansionary fiscal policy. And we'll continue talking about that in this chapter. Again, just to review, the use of fiscal policy is defined as the use of government tax and spending powers to affect aggregate expenditures. It's under the control of Congress and the President. Congress passes the laws on taxes and spending, and the President signs those bills into act. And if the President disagrees, the President can veto, and Congress has the right to, if they have enough votes, to override the veto. So it's under the control of Congress and the President, and so fiscal policy is only as effective as Congress and the President can get along. Right now, we're having troubles with fiscal policy with the COVID recession. This is in October 2020, and currently an additional spending package to get money into the states is on hold as negotiations have pretty much came to a halt in Congress. There is discretional fiscal policy, which is what Congress is working on right now, or trying to. And this is deliberate changes in government spending and taxes to affect aggregate expenditures. So this is done by bills that are passed each year. And so Congress has to make a deliberate pass an act to increase spending or decrease spending, depends on what they're trying to do, and or increase taxes or decrease taxes. Right now, the proposal is to try to increase government spending. The Republicans have, I think, like $500 billion on the table. Democrats want more. They started with $3 trillion, and right now they're pretty much nowhere close to an agreement. Then there's non-discretional fiscal policy. This is on automatic pilot, which is why they're called automatic stabilizers. These are things that are already built into current law or laws. And this is changes in government revenue and spending which counteract inflationary and recessionary conditions that result from no current act of Congress and or the President. So right now we have laws about taxes. And taxes are tied to income for the most part. And so if you have recessionary conditions, what you want to do is you want to take government spending and try to increase it or decrease taxes. Well, automatically in a recession, the amount of money the government takes in tax revenue goes down because income is falling, and as income falls, people pay lower taxes or less taxes. And then inflationary conditions is when maybe we have too much spending, and so when you have too much spending, the economy is usually doing better. At least people have jobs, and therefore they're earning income, and therefore automatically the government increases their tax revenue. At the same time, if you have a recession, people file for more unemployment benefits. And so in a recession, automatically the government will spend more money, not based on any current act of Congress, but based on acts that have been passed in the past. And therefore, automatically the government will spend more money through increase in unemployment benefits, increase in food stamps, increase in low-income assistance. So all these government programs come into effect, and they put more money into the economy, which is what you want to do during a recession to try to counteract the fact that we have less spending out there. So right now, people are not going to restaurants, not going to bars, not going to amusement parks, and therefore a way to supplement the lost income is by increasing benefits to people out there, people who are unemployed, people who are low income, people who need help with putting food on the table, and all that puts more money into the economy. At the same time, when the economy is doing well, people have jobs, they don't file for unemployment benefits, and so automatically government spending on many different areas, unemployment benefits, food stamps, low-income assistance, all of this goes down, which is what you want to do because you want to pull money out because there is inflation in the system. And usually the cause of inflation is too much spending, and so in a situation of inflation, usually the economy is doing well, there's an expansion, and therefore the government pulls back a bit in the spending, and they increase the revenue over here. again, counteract the inflationary conditions of possibly too much spending. So now in Chapter 9, we add in two more variables into our economic model. These are the T for net taxes. This is the difference between taxes paid to government minus transfer payments made by government. Transfer payments are money handed out by government in exchange for no good or service. So, for example, unemployment benefits is not money that's buying anything. It's simply a transfer of money from the taxpayer to unemployed workers to help offset the effects of the fact they've lost their job. So we're just going to look at maybe taxes as being just what the government takes from the economy, and this number is always going to be a positive number. And this is what economists call leakage. This is money leaving the system, and so it's a positive number, and so when we pay our taxes, it's money that comes out of our circular flow. And we're going to assume that this is constant, the dollar amount, which is not true, because I just said earlier, just half a minute ago, that when the economy is doing well, high income is higher, the amount of money the government takes in tax revenue goes up, and when you have a recession, income is down, the amount of money the government takes goes down. That is more realistic, but it's hard to model that in a model that we're trying to create. So again, we're trying to keep things simple, and so we're going to make the assumption that it's constant, even though it's not. We know that, but we're going to assume that T is constant. What it means is that I will just give a number for T, and whatever number I give is the number that students will use. G is going to be government spending, and this is another variable, and this is an ejection in the system. This is money coming in into the circular flow, and so this represents another form of spending. And again, we're going to assume that G is constant, which actually is not too bad, even though government spending can go up or down based on the business cycle with the automatic stabilizers. A fair amount of government spending is predetermined by the government. And so they have a lot of discretion as to what that number is going to be. So now that we have taxes into our model, we have to look at another definition, or not another definition, but another category of income called disposable income. This is what you might call your after-tax income. And this will affect our consumption spending. And so now we're going to have another variable, YD. D stands for disposable. And this is the income left over after taxes have been paid and transfers received. So mathematically, it's going to be identified as disposable income is your regular income, which you might call your gross income, minus your taxes. And therefore, now that is what you do for consumption and spending. So if you look at your income overall, income now is going to be not just money for consumption and savings, but also for taxes paid. And so if we do Y minus T, we're left with C plus S again, and that will be your disposable income. Another assumption, not realistic, but we're going to apply net taxes only to the consumption equation, so it has no impact on investment. Again, just to make the model easier. So now this will change our consumption equation. It used to have just income there in Chapter 8 because there was no taxes. Now we have taxes, and so now consumption equation is going to be your autonomous consumption, which again is the constant, plus your MPC times your disposable income. You can also write it this way, where your YD is equal to Y minus T. Both of these equations are saying the same thing. When we solve for equilibrium, we're going to have to change it from YD to YT because we have to solve for equilibrium Y, and so we'll get to that later. And so now our aggregate expenditure equation is right here. It's now C, D, Y plus G. A lot of times on exams, when I throw in government spending into Chapter 9 and have it solve for equilibrium, they tend to want to leave G out for some reason. Government spending is just the same as everyone's in terms of how it affects the economy. It's still dollars coming in. So if a government buys something, buys a new computer, I'm sure the store that sells it doesn't care it was government. All they care about is selling the computer. This is your C, autonomous consumption, plus MPC times your disposable income, plus your I and your G. And so again, equilibrium is where your aggregate expenditure is equal to your income, and that's your gross income, national income. And I call that, once we solve for y, I call that YE, and that's our equilibrium income. So let's see how government spending and taxes comes into our model, how it changes our model. And so now we're going to add down here three more columns. T for taxes, YD for disposable income, and then G for government. Y is your total income, national income, gross income. C is your consumption still, S is your savings, I is your investment, and AE is your aggregate expenditures, which is now C plus I plus G. And I got, maybe do the first column here, then I'll stop this lecture and go to part 2. So here I give you your autonomous consumption, your MPC, your investment, government spending, and taxes. All these are constants. None of these change. And so T is taxes. That's how much money the government's going to take out of the economy. It's not affected by the amount of income. And so if the income level is $2,000 billion, and these are all in billions, then your taxes are going to be 1,000. If your income is 3,000, taxes are going to be 1,000. All the way down, the same number, $1,000 billion. And let's stop there.